Central banks are hoarding gold at a pace we have not witnessed in half a century. Over 2022, 2023, and 2024, they absorbed more than 1,000 tons per year, something we have not seen since the late 1960s. During the early part of that buying wave, the public funds designed to track gold, the ETFs, were doing the opposite. They were bleeding holdings. In 2022 and 2023, there were fewer shares outstanding with gold above $2,000 than there had been when it was stuck around $1,900. The price was pushing higher while the crowd was still selling. That was not a contradiction, that was a signal. And in the next few minutes, I'm going to walk you through the plumbing of why that divergence existed, who benefited from it, and what it tells you about the next phase of this monetary breakdown. Let me start with the uncomfortable part first. We need to talk about who the real buyer is, because that changes everything about how you read the chart. Central banks collectively absorbed just over 1,000 tons of gold in 2024 alone, roughly a fifth to a quarter of total annual mine supply vacuumed up by sovereign institutions. The People's Bank of China, the Reserve Bank of India, the central banks of Poland, Turkey, Singapore, they are all accumulating at a clip that would have been considered emergency behavior a decade ago. Poland has massively expanded its reserves in just a few years, adding close to 100 tons and roughly doubling its holdings compared with the late 2010s. India has added on the order of 70 tons in some 12-month stretches. These are not speculative bets. These are insurance policies, purchased by the people who print the money. Think about that for a second. The institutions that manufacture currency are exchanging it for something they cannot manufacture. That tells you everything about their confidence in the system they run. Now, here's the part that should make your hair stand up. While these sovereign buyers were quietly filling vaults, Western retail investors and institutional allocators were much slower to move. Gold ETF holdings, the easiest and most popular way for ordinary investors to get exposure, originally peaked at just under 4,000 tons in 2020, then fell by several hundred tons even as the price marched to new highs. Only in 2025 did ETF flows swing back to very strong inflows and push holdings back toward those prior peaks. Even now, the most consistent and price-insensitive buying is still coming from central banks, not from broad retail portfolios. In just a few years, gold has run from roughly $1,900 to around $5,000 an ounce, one of the most violent repricings in its modern history. One of the largest repricings in gold's modern history occurred while ETF flows were still hesitant and uneven. That is not mania. That is the opposite of mania. That is a revaluation happening entirely without crowd participation. Most people think a tripling in price means everyone is piling in. In reality, the only aggressive buyers are the ones who understand sovereign balance sheets from the inside. Retail allocation to gold sits below 1% of total portfolio assets globally. The crowd has not arrived. They are watching from the sideline, convinced this is a bubble, while the people who control monetary policy are telling you with their actions that it is not. On this channel, we do not sell courses. We do not offer signals behind a paywall. We do not peddle fear or fairy tales about overnight fortunes. The entire purpose here is to lay out the mechanics so you can reason through it yourself. If that approach is useful to you, a like or a subscribe helps this reach more people who need it. That is all I will ever ask. Now, if you are a long-term holder, someone stacking physical or sitting in allocated positions with a horizon measured in years, what I am about to describe is context, not a call to action. This volatility is the cost of admission. You already know that. Your job is to understand the architecture of the move, so you do not get shaken out by a manufactured dip. If you are trading this on leverage or trying to time entries and exits on the weekly chart, listen carefully, because the machinery I am about to describe can liquidate your position before your thesis even has time to play out. The gap between being right and being solvent is measured in hours during these engineered swings. Let me connect the dots on silver, because this is where the structural absurdity becomes impossible to ignore. And towards the end, I will show you the single data point that proves the paper market and the physical market are living in different universes. The gold to silver price ratio right now is hovering around 65 to 1. That means you need 65 ounces of silver to purchase 1 ounce of gold at current market prices. Sounds like a number, just a ratio. But let me put it against the physical world and watch what happens. The mining ratio, meaning how much silver comes out of the ground for every ounce of gold, sits in the 7 to 1 range. LBMA Vault data in London shows roughly 3 units of silver for every unit of gold by weight, not 65. On COMEX, open interest routinely represents more than 10 times the metal that is registered for delivery, so the paper claims exceed the immediately available ounces by a large margin. Stack those numbers up. Every physical measure points to a relationship far tighter than 65 to 1, and yet the market prices silver as though it is 65 times less scarce than gold. That gap is either permanent, which would require silver to be somehow worthless despite being consumed industrially at record volumes, or it closes violently. There is no gentle middle path when the spread is that wide. For centuries, the historical ratio between gold and silver hovered near 15 to 1. Entire monetary systems were built on that relationship. We are currently more than 4 times above that centuries-old norm. That kind of distortion does not survive contact with physical reality indefinitely. Here is why this is not just an academic exercise. Silver is categorized by the United States government as a critical mineral. The Department of Defense uses it in guided munitions, satellite components, radar arrays, and advanced targeting systems. Modern guided munitions like Tomahawk cruise missiles rely on silver-rich electronics and batteries, embedding meaningful amounts of silver in each missile. The artificial intelligence build-out, which Washington has formally designated a matter of national security, depends on silver in semiconductor fabrication, thermal interface materials, and high-frequency connectors. Photovoltaic panels for solar energy consume over 140 million ounces annually, and that number climbs every year as capacity installations accelerate globally. This is not a metal you can substitute easily. When military, technological, and green energy supply chains compete with investment demand for a commodity that has been in production deficit for 5 consecutive years, the pricing mechanism eventually breaks. And it has been in deficit. Peak global silver mine output was back in 2016 at roughly 890 million ounces. Production has not recovered to that level since, because roughly 70% of all silver is a byproduct. It comes out of the ground alongside zinc, lead, and copper. Even if silver prices doubled tomorrow, a zinc mine does not suddenly ramp production to capture more silver. The economics do not work that way. The primary product dictates the mining schedule. Silver just comes along for the ride. That structural ceiling on supply is one of the most underappreciated facts in all of commodity markets. Meanwhile, visible stockpiles are evaporating. The Shanghai Futures Exchange and the Shanghai Gold Exchange combined silver inventories have dropped on the order of 90% since around 2020. A significant portion of that drawdown accelerated in 2024 and 2025. That means roughly half of the visible inventory in the largest consumer market vanished in a matter of months. China is simultaneously the largest consumer and a significant processor of silver, and Beijing has already implemented export controls on the metal. If domestic supply tightens further, those controls get stricter. That is not speculation. That is how resource nationalism works in practice. We watched it happen with rare earths in 2010, with gallium and germanium in 2023, and the pattern repeats every time a strategic commodity faces domestic scarcity. So we have a supply that peaked nearly a decade ago, demand that is structurally locked in by defense and technology priorities, stockpiles that are vanishing in the largest consumer market, and a price that still reflects the fantasy of the paper derivatives complex. The COMEX alone carries open interest, representing multiples of actual deliverable inventory. The mechanism is straightforward. Contracts are created, leveraged, rolled over, and settled in cash without metal ever changing hands. This allows the paper tail to wag the physical dog, but only as long as nobody calls the bluff in size. And that brings us to the antagonist in this story. It is not a cartoon villain, it is a structural incentive. The exchanges and the large commercial banks that act as market makers on COMEX profit from volatility, from contract turnover, and from the spread between paper prices and physical premiums. Their business model depends on the paper market remaining the dominant pricing mechanism. The moment physical delivery demand overwhelms their ability to settle in cash, the entire architecture loses credibility. That is what they stand to lose. What you risk is buying into a paper price that does not reflect the scarcity of the actual metal underneath it. Here's the mid-video reveal that reframes this entire picture. Pull up the managed money positioning from the CFTC Commitment of Traders Report. This is public data, released every Friday, free to anyone who wants to check. Managed money, which means hedge funds and large institutional speculators, has pulled its net long exposure in silver down to levels not seen since February of 2024. Why does that date matter? Because February 2024 was the exact trough in speculative positioning right before silver launched into one of its sharpest rallies of the cycle. Managed money is one of the most reliable contrary indicators in commodity markets. When these funds crowd into one direction, the trade is usually exhausted. When they flee, the runway opens. Right now, they have fled. The rubber band is stretched to the same tension as the last time it snapped violently in the other direction. Analysts with documented track records of nailing prior inflection points, including the calls on $2,500 and $3,000 gold that materialized exactly on schedule, are projecting substantial further upside in silver through year-end. You can verify their past calls against the actual price history. The data is public. We will come back to what this means for timing. But first, let me zoom out to the architecture of the monetary system itself, because gold and silver are not rising in a vacuum. They are responding to something structural that every central banker on earth can see in the math, even if no finance minister will say it out loud. Since 1971, every administration, regardless of party or ideology, has spent beyond what the economy produces and what taxes collect. The gap gets filled by debt issuance. That debt gets monetized when the central bank creates reserves to absorb what the market will not buy. This is not controversial. It is the mechanical description of how deficits are financed when buyers thin out. The result is currency debasement, not in one dramatic event, but through a slow erosion of purchasing power that compounds over decades until the exponential phase arrives. We have crossed the $36 trillion mark on United States national debt. Debt to GDP now sits above 120%. Interest payments on that debt have surpassed the defense budget. The math does not work without perpetual refinancing at manageable rates. And manageable rates require money creation, and money creation is debasement by definition. Most people think gold at 5,000 means gold is expensive. In reality, gold at 5,000 means the unit you're measuring it in has lost that much credibility. The metal did not change. The ruler shrank. Fiat currencies do not collapse in a single afternoon. They lose trust through a long accumulation of broken promises, misreported statistics, and quiet theft of purchasing power. And then the exponential phase kicks in, and everyone acts surprised, as though the math was not sitting there in plain view the entire time. Gold crossing 5,000 is the market's way of screaming what policymakers whisper. The purchasing power of your savings account is being diluted on a schedule, and the schedule just accelerated. Policymakers right now face an impossible fork. Save the bond market by keeping rates suppressed and printing liquidity, which accelerates currency erosion. Or save the currency by letting rates rise and liquidity drain, which implodes the debt structure, craters exports, and triggers a cascading credit event in a system that runs on cheap refinancing. Since the entire global financial architecture sits on a foundation of sovereign debt, the bond market cannot be sacrificed. So the currency takes the hit. That is not a prediction. That is the revealed preference of every major central bank over the last 15 years. They always choose inflation over deflation, because deflation kills the debtor, and the largest debtor on the planet is the sovereign itself. Japan has been running this experiment longer than anyone. The Bank of Japan holds over half of all outstanding Japanese government bonds. The yen has lost roughly a third of its purchasing power against a basket of commodities since 2020. That is not ancient history. That is a live preview of the endgame for any central bank that chooses the bond market over the currency. And that is precisely why central bankers are buying gold. They are not doing it as a trade. They are doing it as preparation. They understand the endgame of the system they administer. They are acquiring hard assets while the window is open, before the rest of the world catches on, and the premium for doing so becomes prohibitive. Now, notice something else. There is an invisible fence around precious metals that does not exist around any other asset class. Capital gains taxes on physical bullion are higher than on stocks in most jurisdictions. In the United States, physical gold and silver are taxed as collectibles at up to 28%, far above the standard long-term capital gains rate. Dealer premiums eat into your entry. Storage costs accumulate. Banks give you a puzzled look when you mention it. Friends and colleagues treat you like a doomsday hoarder. The entire experience is designed to make you quit. Most people do quit. They go back to equities where the friction is lower and the social approval is higher. But the ones who endure the friction are the ones positioned correctly when the monetary architecture finally buckles. That friction is not accidental. It keeps the crowd out until it is too late for the crowd to get in at these prices. Now, the bearish scenario first, because intellectual honesty demands it. Gold at 5,000 after a near vertical run is technically extended. Parabolic advance is correct, sometimes violently. Silver at 77 has not reclaimed key resistance, and that leaves it exposed to another engineered flush. If COMEX operators raise margins during a low liquidity window, say when Shanghai is closed for a holiday and Eastern physical buyers are absent, they can trigger a cascade of forced selling that takes prices sharply lower in hours. We have seen this playbook dozens of times over the past 2 decades. It works, it is legal, and it resets speculative positioning to their advantage. For traders using leverage, that kind of move is a shredder. Your thesis can be perfectly correct on a 12-month horizon and still destroy your account on a Tuesday morning. Now, the bullish scenario. If delivery demand on COMEX continues to rise, if Shanghai stockpiles keep draining, if central bank buying remains at or above the 1,000-ton annual pace, and if the managed money contrary signal plays out the way it did in 2024, then the next leg higher could be the one where the crowd finally arrives. Retail participation in gold remains below 1%. ETF inflows have not even approached their 2022 highs. Wealth preservation clients, the ultra-high net worth individuals and family offices, are buying physical, not paper. They are not trying to get rich. They are trying to stay rich. They understand that holding a currency that is being actively debased is not a preservation strategy. It is a slow liquidation. When that mentality migrates from the top of the pyramid to the middle, the demand shock for physical metal will be unlike anything this market has priced in. So where does this leave us? 3 things to take away. Number 1, the gold to silver price ratio of 65 to 1 is disconnected from every physical metric on the planet, which ranges from 1 to 1 up to 11 to 1 depending on the measure. That gap does not persist forever. When it corrects, the move in silver will be disproportionate and fast. Number 2, central banks are the dominant buyers of gold at these levels, while retail and institutional ETF holders are net sellers. When the people who print the money are exchanging it for metal while the public exits paper exposure, you are watching a transfer of real wealth from those who do not understand the system to those who designed it. Number 3, managed money positioning in silver mirrors the exact setup from February 2024, right before the last major rally. The contrary indicator is flashing. The stockpile data supports it. The structural production deficit has no resolution on the horizon. The unresolved question is whether physical scarcity finally overwhelms the paper pricing infrastructure this cycle, or whether the operators manage one more engineered reset first. Nobody can time it precisely. The structural forces are undeniable, but the system's capacity to delay the reckoning through contract rollovers, cash settlements, and margin manipulation is also real and should not be underestimated. If you're holding physical for the long term, you already own the answer. Patience and conviction are your only responsibilities. If you're trading this with leverage or short time frames, respect the volatility. Have a plan before you enter. Know your exit before you need it. And understand that being right about direction does not protect you from being wrong about timing. This market rewards clarity and punishes recklessness without mercy. Verify everything. Pull the COT reports from the CFTC website. Check the Shanghai inventory numbers. Compare the ETF holdings to the price chart and see the absence of the crowd with your own eyes. Look at the debt GDP trajectory and ask yourself whether there is any mathematical path to resolving that without further debasement. None of this is hidden. It is all public. The information is sitting there for anyone willing to look. The question is whether you look now or after the rest of the world figures it out. Tell me in the comments whether you think physical delivery pressure breaks the paper complex this cycle, or whether we see one more managed correction first. This is not financial advice. This is pattern recognition, data analysis, and a conversation between people who refuse to be passengers in their own financial future. Thank you for watching. Protect yourself. Build the fortress. And I will see you in the next one. Nothing in this documentary is financial advice. Always do your own research and consult a licensed professional before making financial